Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
This week, we're going to talk about why timing your refinance is harder in a falling rate market environment. Today is all about refinances and how to time the market. And here's the controversial take right out the gate. Refinancing timing may be more important than refinancing rate. Yell at me in the comments. Rate is not everything in this changing rate environment. We're going to talk about that today.
But it can be.
It can be, but look, people are asking the question, should I refinance now? Should I wait till later? Rates are here right now, but I got the situation happening. Should I wait for it to get better or not?
Yeah.
We need to talk about this because I know you're fielding those questions. I see people online talking about this, and here's what we've experienced. Sometimes waiting and delaying gives that analysis paralysis, and then the trains left the station and they didn't make the choice when they could have.
Correct, yeah.
So look, I'm just saying this because we've watched people walk through this pain process, and it doesn't have to be painful.
It doesn't. It
So,
can all be avoidable.
Let's go. First thing is...
Avoid the noid.
So the first thing is the idea that, I'm going to wait for the bottom. So I want to talk about why does waiting for the bottom always backfire on people?
So for me, I think waiting always backfires because of the fact that homeowners refinance too late, never too early, and they only know what the bottom is after rates already did what they did. So by that time, when people try to get in the market, lenders are already full, maybe they're backed up, or the market already changed. So I feel that they're chasing the bottom, and in between chasing the bottom, they never pull the trigger because they don't have that confidence, and maybe they didn't run their numbers to actually know what that looks like. So I feel like it's that hesitation of pulling the trigger because maybe it's not the right time. Maybe the rates aren't too low yet.
Okay. What's your take on that?
No, I'm right on with that, with Brian, with that. Here's the other thing. A lot of people are just fearful. They just don't know what they don't know. They fall out of the media, and the media a lot of times is not giving you the best information out there possible. The great thing about it is we know what's happening now and why we're doing this podcast right now. It's so important to pass on this information to homeowners that are that weren't in position to refinance early enough or didn't meet that 210 days like they have to do for VA and FHA, right? Like now is the time to start preparing.
Can you explain that in more detail for people who may not know what that rule is? Explain what the 210-day wait period is all about.
Yeah, so absolutely. When a new homeowner purchases a home, they close escrow, the clock I'm going to say it's kind of like a prepayment penalty, okay, where the government doesn't, or not the government, but the servicer does not allow you to refinance in a certain point of time.
Right, too early.
Too early, exactly. So you have to wait 210. Two things have to happen. You have to wait 210 days from the time that you met your first payment. So let's say we close here in December. Your first payment's not due until February 1st, but you make your payment on February 10th. You have to wait 210 days from that time that you made that payment.
On February 10th, not February 1st when it was due, but on the day you actually made the payment, then 210 days.
Then 210 days. And then the next thing that has to happen, which will happen first, is making 6 consecutive payments on time.
Yeah.
That qualifies you already. So most of the time before the 210 days, we start working like maybe 30 days prior to prep that person to get ready to take advantage of that lower rate.
So quick point of action here. If you are that person and you bought a house in the last, year and you've made those 5 payments, the 6th one's coming up, this is where you start doing that game plan right now. Where you go, okay, let's march from my first payment I made. What's 210 days from that? If that 210th day is ahead of you on the horizon and we're in a declining rate market, there could be a good match for you to take action on
Absolutely.
that. That's what I'm trying to get at.
Exactly. No, that's perfect. I'm glad that you brought that up.
Yeah.
No, and to add on to what Will says, like I feel that sometimes people focus too much on the risk of the rate. Like, what if it's going to go down lower, but then they fail to forget, like, what's happening in my life? Is my job stable? Am I incurring a lot more debt? Do I need to have big payments that I should have maybe some extra money for rainy days? And a lot of people feel like they need to refinance when the time is perfect, but you need to refinance when you're in the position to be able to do so. And how you do that is by, asking the right questions, running your numbers, running different scenarios of what it would look like for you to get cash out, maybe rate and term, but then you exactly know how to position yourself when the time comes, and you're not playing that catch-up game when the market already did what it needs to do, and you're just trying to get that rate that was low maybe last week or the month before. Yeah,
and to add to that, a lot of people think that they're just fearful, like, I just don't think I'm in the right place. I don't think that my income is going to be good enough. Just please talk to your lender, just figure that out. They may be able to get creative. There's so many other different programs that are out there available now. Maybe they'll just do a line of credit instead, or maybe consolidate everything, bundle everything in one. Maybe go, if you're self-employed, you could do a 12-month bank statement or a 2-month with the P&L. Like, there's so many different strategies on how to get creative to set that person up, for the proper strategy. As a matter of fact, we're currently working on a refinance where it's a 12-month bank statement. The interest rate is a 6.875, 30-year fix, okay? They're doing a cash out because they're building an ADU. The beautiful thing is, after looking at other options, there's another program that's an interest only, okay? And so we had to charge origination at that 6.875. But instead, what we did is we found a better product for that client and put them at a 7.375 lender paid, where we're letting the lender pay for our compensation, and we put them at a higher interest rate. The payment is for $1,160,000. Can't believe I remember this. The payment was $7,621, more or less. At an interest only, the client was first like, why do I want to increase my rate? Why do I want to do interest only? Well, the strategy here is that in 8 months, once you're 8 to 10 months, you're done with your ADU, we're going to refinance everything. We're going to put you in a better place. So at a 7.375, the payment was only 71 and change. So I'm saving you $400 and change dollars. Why not take that approach right now? And I don't charge you anything, no origination points.
Yeah.
So the client's like, what? In the beginning, it was hard to swallow because you see a higher rate. Why is my payment much lower than this? Well, it's because it's interest only. Now you get to determine how you want to pay down your mortgage.
And that's the advantage when someone has the flexibility and they have the time frame where they can make those choices, and they have a game plan where they're trying to build something. It's going to increase the value of the property. Because the value of the property is increased, then they'll be able to better refinance that remaining debt, if you will, into a better position that's long-term going to suit them better.
Exactly. So we're doing a cash out right now at 80% loan to value.
Yeah.
When the future value is going to be at 65 LTV.
Yeah.
Because they're doing a value add to it. So that's going to put them, now it's not a cash out, it'll be a rate in term. So therefore the rate should drop way lower.
Really substantially, yeah.
That's where I wanted to add on to that I think that's literally the way that people are winning right now, where they're being strategic and not emotional. And they're looking at it in a way where it's like, how can I set myself up to win later? Because I know right now it's a tricky environment, but if you're able to weather it, you're able to maneuver your way through this type of market, down the line, you're setting yourself up. So every setback that you think you're going through, it's actually a setup for down the line. So when the market comes lower or it gets better, you're already going to be in a position that you're positioned to be able to make the right decisions, or make the decisions you want without having to be like, this is what I have to do. Like, now you're in charge of what the destiny is.
Exactly. The other beauty, we already know rates are starting to go down. So it's like seeing that light at the end of the tunnel, right, Andy? Like, I can finally see like some softening here.
Well, and I think for some people, maybe it's a little bit more of a digestible period of time to do this, because they see that on the other side of this decision down the road long enough, like, it will be more favorable because the market's already trending that direction. So maybe some decisions are a little easier for you on this side of the coin, because you know what's coming next is going to be even more favorable. You're adding value and cash flow into the property. It's going to be worth more, and you're going to be able to get a refinance at a lower rate later than you're going to have now. Those things are all looking up. But I have a question for both you guys. Because of where I sit in this office, I overhear you talking to people, and sometimes I hear people say, I should have called you sooner, or I should have listened to you when you said blank, or whatever. So talk to people right now. Like, what's the risk of waiting right now in this changing rate environment? What are the risks of waiting?
The risk of realistic or waiting is just, you're going to be challenged more. Right now, now is the time to save money. If you made your payments, like if you're a veteran or anything, you wanted to do a VA or take out of it, you have to wait 210 days. But at least now you can see the advantages of doing a refinance now versus maybe waiting and seeing, like, are the rates going to go down? You got to position yourself now on something that you do, because we don't have a crystal ball. We don't know what's going to happen later, but we know what's happening now. So if you can take advantage of it now and it works for you, don't run the risk that maybe something won't happen. And now you're just, hey, shoulda, coulda, woulda, and I didn't do it, And so, I'm glad that you're bringing up that point.
Yeah, no, to add on, right online with what Will said, it's you're losing the opportunity to be positioned in the right place for the right move that's going to benefit you, your future, or your family, or whatever goal you're trying to, make happen. And I think that's the biggest factor that people miss out because they're like, oh, I'm not ready, so I'm not even going to try to do anything. But if you're constantly knowing, what scenarios are available, what options you have available, maybe right now isn't the time just yet, but at least you can future pace that and know that, okay, this is what I can do when this comes up. Rather than playing the catch-up game and try to, figure everything out when the market is, coming down, you're coasting into this, with your options already laid out, with, what moves you need to make already placed in ahead. And now you can go into it with confidence, without the fear, and plan into it without having to just act reactively.
Okay, so let me take the other approach angle then. On the completely opposite side of this is, who would you tell right now there's no way you should be considering refinance? Who are those people? Like, hey, don't even do it. Like, what's the scenario? What's the situation? Or what would be the cause that they shouldn't do it? The reason I'm asking it so point blank in like third grade is because I want people to know where
for
they fit in
instance,
this.
absolutely. So I have a couple of VA people. I didn't take advantage back in September when I should have refinanced. Yeah. But my current interest rate is 5.875. Right now, I get a lot of mail that says, oh, I can go into the 4 point something. I tell them, just look at the fine print. That's going to come at a cost. If you look at the national average of what interest rates are for government that are conforming loan limits, which is now in 2026, the new conforming loan limit went up to 832. Okay, 832,000. So anytime you're hitting below that, you're at a conforming loan limit. Interest rates are going to be about that 5.5% for government, for a VA, right? But if your rate is at 5.875, I don't know that makes perfect sense right now, because what you don't want to do is buy down the rates right now.
Yeah. If
you can wait a little longer, right? We already know there's indicators here. We got the federal Uncle Powell is going to be replaced come May. And we're going to put a more dovish federal chairman there. Somebody that's going to be listening more to the current administration, because we need to reduce our current interest rate to make affordability come back. We need some type of movement. And so the other thing that we're hearing with the administration, since the federal government's not reducing the federal funds rate fast enough, is he's getting Fannie Mae and Freddie Mac, to start buying mortgage-backed securities. The great thing about this is Fannie and Freddie are not the ones that do the loans. It's like, let's just say it's Bank of America or it's us. We do a loan, and they're going to pretty much buy back that mortgage-backed security. Okay, so they're a government-sponsored enterprise, is what it is. And so what they're saying is like, since the federal government buying, and we're taking care of you, Fannie and Freddie Mac, you buy these things. Now we can tell, like, hey, these things, they're going to start slowly buying some of these mortgage-backed securities where interest rates have nothing but to go down.
Yeah, yeah.
So should somebody, like in this case, that they have a 5.875, I'm like, no, just be on standby. Let's prepare. I already have their mortgage statement. I already see that they have a certain rate. So my system, as soon as I can do 0.75% lesser at no cost to them, that's when I think now we put them in a favorable position to take advantage of that.
So is that like a massive cloud sign in the sky? Like, do this now would be three quarters of a rate lower than one you have now, and do it at low or no cost.
Correct.
Okay.
And most people right now are like 0.5% or less. It's as long as it's 0.5% or more, you're good to.
You're getting close. Yeah.
I like to do 3.25% to 1 full percent.
That's what I was here.
Why not do that, right? Like, where you're not buying down your rate, though.
I got it. Yeah.
And I feel like on the conforming loans below that 800 mark, those quarters or those small percentage changes don't make big of a difference.
Yeah.
If you're up in the jumbo loans or if you're up in the non-conforming areas, those small 1/2 or 1/8 of a percentage could make a little bit more of a difference for you. So just keep that in mind. And for me, I honestly think it's, also the people that maybe bought maybe a year ago that have a higher rate that is not under that 1%. I think you guys need to still hold off for a little bit. And unfortunately, people that have racked up a lot of debt, just because you have that debt and you have your house and you want to cash out, that doesn't always work in the best favor, because you also have to approve through a debt to income ratio. So make sure that's why it's so important to sit down and go over your options so that you know what you're able to do, because just because you have the equity doesn't always mean that you can tap into it.
That's it. The other thing is, a lot of people that do have plenty of equity and are looking, finances are pretty difficult right now. You can tap into some of that equity to actually build out an ADU, especially if you're in the state of California, where they're just so friendly about this. I mean, I can't drive around the street without seeing something being built.
Not anymore.
You know, so
It's all over.
it is,
Everywhere.
and it's getting more popular. You know, and so it's just another way of leveraging your situation right now.
And just like, like the ADU and the ADU rush and everything, like we've been knowing about you built your first one how many years ago?
Yeah.
So like we've been knowing about this, but just like the market, just like things come into the market, a lot of the people and consumers get this very late. So that's why it's very ultra crucial to just, tie your ass with people that you believe, that you trust, that can give you that information in a way that you can learn it. Because half of the time when you heard it through social media, where you heard it through the mainstream media, it's already diluted and it's already passed.
Yeah, something I know, and I don't know if this is heavy-handed or not, but something I know we've talked about on the show and offline a lot is like choose your hard.
Yeah.
Like, look, if your situation right now is already hard, and you have an opportunity to make it better, and you don't, you're choosing the current hard to just continue. If you are going to go, oh, maybe I got some home equity, maybe I want to convert that garage. Okay, that's going to be a little bit hard too. Choose your hard. Like, you just stay put and let that be hard on you, or create a new income stream for yourself or whatever. You have already talked about like refinance stacking. Like, we're going to do this one now.
Yes.
And then we're going to plan for the other one later. That's going to probably be a little bit hard too. So by no means is this going to be like some super easy cakewalk vending machine refinance. Yeah. Put your quarter in, refinance comes out the bottom. That's not the deal. But you have to then be honest about the situation you're in and go, which hard am I willing to tolerate and endure for whatever period of time you got left in this place and whatever goals you're trying to accomplish.
Exactly. And the main part of everything that we've been talking about is just prepare yourselves.
Yeah.
Just mentally prepare yourself, and then just start little by little gathering your documents. And it's very simple documents: your most current mortgage statement, your pay stubs, your W-2s. If you're self-employed, you could do 12 months. There's other ways. There's a profit and loss. Just kind of prepare yourself mentally and see what you're able to do. Take a look at your backyard. Is it something that you want to build? And maybe you thought hey, I saw Bob the Builder, the cartoon, and maybe I want to build something. You never know.
Can you tell that Memo's spending a lot of time with his grandkids?
Oh, yeah. Bob the Builder.
Bob the Builder.
Could have been HGTV, like regular people. No, Bob the Builder.
Yeah. But
Handy Manny.
So the whole idea behind all of this is just prepare yourself, and give that mortgage statement to your lenders, have them put it into his system, his CRM, whatever they're using, to make sure that they're informing you when the time is right. They're going to contact you right away. Those are things just simplify your life, and at least now we're in full alert, or you put your mortgage partner in full alert.
So, I'm so glad that you brought that up. I actually had a client that just did this exact same thing. So they're in a position right now where they bought in 2023 and they bought a duplex. And they bought it with their VA loan, 0% down. And they just recently, within the last 6 months, had twins. So they had two babies. And they were living in the smaller unit. So they're like, hey, we're going to need a bigger room. And, we don't know what to do. They're like, we're crossed between the roads of selling the property, refinancing, or just buying with my VA again and paying the difference. So before, we got into the numbers, I asked, well, what's your goal in the end?
Yeah.
He's like, well, I want to have something that I can, always have. There's a lot next to the house that we have in between the lots, so there's space to develop. I'm like, okay, well. So then we're like, how about this? Let's just run the numbers. Send me your mortgage statement. Send me your stuff, and let's just see what makes the most sense. Yeah. Let's just see what makes the most sense. We went through the scenarios of the refinance breakdown that we send our clients, and I gave him two scenarios. One with him, paying his own closing costs. One with him refinancing conventional and financing the closing cost. And he looked at them, and he's like, oh, wow. It's a lot different than what I thought. Like, I'm at a 4.5. My rate's going to go up to a 5.99. He's like, it's only a $400 difference. I'm going to rent the property out. I'm going to, get $5,500. So I'll wash it. And he's like, He's like, well, Brian, our goal is always just we have that lot next to there. So we want to eventually build something and develop. I'm like, this is why I wanted to run this, so that you can clearly see for yourself what options are there. So I'm like, what option would you take now? He's like, refinance, free up my VA, buy my next primary, free and clear with my VA, put this into a conventional, let someone else pay my debt, leverage that, and then work slowly to develop another ADU right there. And I'm like,
and we already know, here's the great thing about the creativity. Like, my mind is just spinning. Is it easier to get a ground up construction loan as an owner occupied or as an investor?
As an investor. And that's exactly where I flipped it. And I'm like, now that you're buying your next primary, right?
Yeah.
This turns into an investment. Now I can help you finance all that cost for that ADU. And he's like, all right, Brian, what's next? What's the next steps?
And that's the beauty. Like, really, audience, it's easier to obtain ground up construction based on future value of what you're building as an investor.
So ridiculous.
Right? There is no pay stubs. There is no tax returns. You do not have to have experience. The person that has to have experience, though, is your contractor. And as long as you have a contractor that is experienced, that you trust, that will go in there, we'll give them the money.
Yeah.
We'll give them the money. Oh, and I'm sorry. If the investment has enough money, we can do what's called an interest reserve. And then you don't have no monthly payments. The payments are included already in your loan, which is just crazy. I mean, that's how I do mine.
That gets exciting. Like, I get excited because it's like you don't know what you don't know. But if you tie yourself with the right people, you get access to information that you wouldn't if you wouldn't have.
Yeah.
A long time ago, we've been telling people all the way, all the way over here off screen. There's the timeline. We started telling people, just watch the market get creative. People are going to come up with solutions. Money's got to move because money. It's like water, where water gets stagnant and stale. It gets bad and deadly. And money's the same way. The money's got to move. It's got to cycle. It's got to siphon. And this is a great example of that.
Well, that was us back in 2023. When the market shift, we were always used to just doing traditional financing.
Mm-hmm. Yep.
2023 was when I started surrounding myself with investors. I'm like, well, wait a minute. I have several properties. What can I do? How do I do it? Da, 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 da. And, that's when I bought my first subject to property too. Mm-hmm. That's when we started like really exploring other options, and we started doing fix and flip. And then now I'm like, do I ever buy a property traditionally, or do I go buy my fix and flip with a 10% down, right? Knowing that then I can refinance into a DSCR and do whatever we do. So here, it doesn't matter what caliber. If you're a first-time home buyer refinancing your first-time home, whether you're an investor, now you're looking to do, like, the great thing about being surrounded by a bunch of other different entrepreneurs is that you find the solution. You find the way to get creative and find the best solution for that first-time home buyer or the person that's refinancing, that investor. Right now, we're dealing with a lot of investors that are just looking like, how do I take my money out of this property to go build?
Yeah, everybody wants to develop. It's like the big,
it's happening.
It's the big boom. I've been getting a lot of calls for that.
Our refinances, the majority that we've been doing is to pay off debt.
Yep.
The bad thing about 2023 and that cycle is just the market has been very difficult, and people, the fact is, they're tapping into their equity to help alleviate a lot of that debt that they have. And I'll tell you, a lot of the people that are like, Will, how do I go from my 2.75? Now I'm going to 5.75, 6.5. But when you consolidate all the debt and they pay off $130,000 worth of debt, and then you look at the payments that they were paying on that versus what they're paying now, it's like, wait a minute, I'm saving $2,000, $3,000 a month because I did this. It no longer becomes a rate problem. It becomes now I can breathe, I can get back into place. And then wait a minute, if I apply $1,500 out of that and I learn to invest it back in me by paying down my principal, it just, it's like, why didn't I do this earlier? Why was I waiting, this long to put this into effect?
Yeah, that's really good.
Really good. And those are the facts. That's what we're seeing. A lot of the people are challenged right now. I'll tell you, I've been challenged. 23 was a very challenging year. 24 was challenging. 25, it got way better. And I'm telling you, like, double better.
Like when you said that, I thought about that too. I'm like, did it get better, or did we just become more skilled? That we were able to, take on different types of problems. The market did what the market did, but we also grew in those last 2 years. The market does what the market does, but I feel that it was because we also put in the work to learn other skills, to put ourselves in other places. That business did get a little bit better. Yeah,
absolutely. But let's take also in consideration that interest rates are way lower than they were. In last year, they were in the mid 7s.
Yeah.
Prior year, they were like almost hitting the 8s.
Yeah.
Like now, right now, we finished off the year being like in the low sixes.
Yeah, those sixes.
It makes a big difference.
It makes a huge difference.
You know, and even like that, this year it started very slow.
Mm-hmm.
And those are facts. It started very slow. Even though rates are lower, it's just there's a lot of skepticism out there. When do I wait for the proper rate? When do I find that proper house? You know, the bad thing here in San Diego, it's like, yeah, homes are not selling as fast. But if you call that as fast, 47 days on the market, Jesus.
Yeah.
You know, we only have a 3-month supply of homes right now.
Yeah.
Mm-hmm.
It's not till we have 6 or higher when it becomes a buyer's market. It's still not that.
So I want to ask you guys a closing question for today on refinancing.
No.
All right. Well, end of the show. What do you guys wish more people knew, more homeowners? What do you wish they knew, or what would you want to say to encourage them before they refinance?
I would say that, running your numbers and talking to a lender doesn't, like, how do I say it, force you to do the loan. It just forces you to understand your position. And I think that's what people need to understand, that getting answers, getting numbers, getting your questions, cleared up is what the gist of talking to a professional is. Not so that you can go and do the loan right away and they can tell you like, oh yeah, you have to do it. No. You just have to get the information, then you could choose whether you make the decision or not.
That's it. It's just like a doctor. When they tell you you're sick of this and I'm not, go get a second opinion. And then if you're not happy with that one, go get that third. It's all about being vocal. It's all about out there asking questions. If you're not asking and you're not making it a contact sport, you're not going to know. So what I would say to somebody is be vocal. Go out there and just ask the questions. I know financing is not everybody's favorite subject, but it's one of the most important subjects to really discuss.
100%.
It's like, I don't like having a budget, but how important is it to have a budget?
Yeah.
Yeah. And so
yeah,
these are the things. And this doing the right refinance could build a better budget for you and have the best solution for you and your family. You just have to be vocal and you have to ask.
Yeah. That's awesome. Thank you guys for bringing all these items up today.
Yeah.
Super good show, Brian. Glad to have you back, all of us together now. This is wonderful. If you missed last week's show, you missed us introducing Vero for the first time, who's joining the team and going to be joining the show. She'll be with us probably about once a month every show. We also have some other friends of ours that work here at Mortgage Heroes alongside us day in, day out, week in, week out, that are going to start joining the show and folding in with their market opinion, their perspective as well. So Memo and Brian, thank you so much for doing such a great job today. Thank you all for watching.
Thank you, guys.
We'll see you next week. Bye.
See ya. If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.